Now, India's strong first half growth, robust capex, and resilient exports have kept the economy on track. But ADB says pressures remain, especially from rising protectionism to limited room for rate cuts. My colleague Snehi caught up with ADB's senior country economist Abhijit Sen Gupta, breaking down the outlook for India's growth, inflation, and exports. Let's listen in.
Key factor that has driven this revision is basically the stronger than expected performance in the first half of the fiscal year, when the economy overall has grown by 8%. So a number of factors has led to this growth. Firstly, consumption has remained strong, and this has been aided by the lower tax rates, a good monsoon, weak inflation, all of which bolstered the purchasing power. Secondly, government capital expenditure has been quite robust in the first half, which has also helped to push up growth. Exports till now have performed better than expected, and this has been primarily due to strong services and electronics exports, and also the fact that the exporters have been successful in diversifying to destinations other than the United States. The robust health of the economy is also evident in the corporate earnings, which have been remained strong. Credit growth rates, which has again remained very strong, and increased flow of funds to the commercial sector. Now, having said this, we do expect growth to soften in the second half because of the waning of some of the immediate strong impact of GST cuts on consumption that we have seen in the last couple of months. So that is expected to soften. The fiscal spending, which again, as I said, government capex has remained quite strong, but the fiscal spending will tighten to meet the deficit target. Exports will start to slow down following the tariff rates in hike, and import bill will pick up due to the strong demand for gold and a weaker rupee. So those are the factors that have led us to revision of the growth forecast for this year.
Okay, so Mr. Gupta, you've mentioned a bunch of tailwinds that could help India's economy going ahead, and you've also given us a bunch of reasons why the economy could slightly stabilize in FY27. Is that the reason you've kept your FY27 outlook unchanged at 6.5%? Because yes, on one side, we are also inching closer to some amount of clarity on the US-India trade deal. Do you think that could have a positive role to play when it comes to the economic growth back home?
Yes, absolutely. So we have retained our forecast for the next year at 6.5%, and this is based on a combination of a number of factors. So if I can speak first on the downside. So we are already seeing signs of a less benign global environment with additional countries imposing protectionist measures. The positive impact of the monetary and the fiscal stimulus that we are witnessing will start to wane sometime in the second half of next year. The base effect will also turn unfavorable for the first half of the next year. But this is to be offset by a number of upside measures. So first, on the upside, one would expect that the private capex is likely to receive an uptick because the strong consumption that we have seen till now will result in strong capacity utilization. Moreover, the government over the last several months have introduced an array of measures which can incentivize growth. These include the enhanced labor market flexibility by revamping the labor laws, simplification of the GST, relaxation of import restrictions in the form of QCOs for selected products, and credit relief and support to exporters who would be affected by the US tariffs. And we find the risk remain balanced, to come to your question, with downside risks coming from potential escalation of trade tensions and if there are any weather-related shock. While if there's an upside risk, I would say that would emerge if trade negotiations with the US yield a lower tariff rate for India.
Okay, and Mr. Gupta, we've spoken about one leg of the economy, that's GDP. Let's talk about the other and talk about inflation. The most recent inflation number also right at par with the expectation and much comfortably lower than the RBI's band of that 4% target that we've been setting. Do you believe inflation will continue to surprise on the downside, or do you believe that there could be some headwinds over there?
Thank you. So if you see in the same publication where we have revised our growth upwards, we have also revised down our inflation target from 3.1% earlier to 2.6%. And this is basically because of lower than expected food prices, which have been driven by favorable monsoon conditions and a strong crop output. Now, the core inflation has also held up reasonably well. The uptick due to high gold prices is currently being offset by lower GST rates and some excess capacity in China, which is exerting downward pressures on goods prices globally. Now, going forward, we do expect inflation to inch up steadily from the fourth quarter of the current fiscal year as the base effect reverses and some impact of a weaker rupee transmits to domestic price. And then going on further to the next financial year, we do expect the uptick in inflation will continue. As food price increases with the base effect reversing, the effects of the GST tax cut will flatten out, and a weaker rupee will also impose inflationary pressure. So that's why we forecast inflation to average around 4.2% in the next fiscal year.
Okay. And Mr. Gupta, talk to us about the rupee, because while we're talking about the economy, we have to address what is happening with the rupee, the fresh new falls that we're seeing in rupee by the minute, rather. What is your take on that? And yes, during the policy meeting, the governor did announce instruments to intervene and try and control this fall. But how effective do you think these measures are going to be?
Yeah. So the fall in the rupee is largely driven by some unfavorable movements in the India's balance of payments over the last several months. Now, on one hand, we had higher gold prices, which have hit our import bill. Then going forward, the impact of US tariffs, if they're not reversed, will continue to exert pressure on the exports. So overall, the current account deficit is under some pressure. At the same time, there has been a discernible slowing of FDI and portfolio inflows, net inflows in particular in recent years. So a weaker rupee here should help to boost the exports and disincentivize imports, and therefore help keep a current account deficit at a sustainable level. Now, another factor is currently the US tariffs on India are significantly higher than compared to our ASEAN peers, right? So therefore, India is at a competitive disadvantage as long as this differential persists. So rupee depreciation can help to mitigate this competitive concerns to some extent. And as you rightly pointed out, I mean, fortunately, India seems to be well prepared. Right now, there is a sizable stock of reserves that the RBI can step in to prevent if there is any disorderly movement of the currency. And also, India benefits from current level of low inflation and benign global crude oil prices, which will also mitigate any immediate inflationary pressures arising from the depreciation.
Okay. And lastly, Mr. Gupta, before we let you go, talk to us about what could, or rather which segment of the economy could drive this growth like that you're penciling ahead. The rural economy has been doing very well for itself. The urban economy is still trying to find its footing to some extent. What could be the next growth lever here?
Right. So let me try to respond to this in a slightly more long-term manner. So India, as we know, that needs to grow at about 7.5 to 8% to achieve the status of Viksit Bharat by 2047. And achieving this would need all parts of the economy to grow together. So I wouldn't put it so much as a question of rural or urban, but strengthening the rural-urban linkages, because both parts of the economy are important. And let me explain. So majority of India's poor still live in the rural areas, and agriculture and the allied sectors still continue to support 40% of our employment. Thus, there is a need to raise the agricultural productivity as well as diversification by promoting non-farm employment, so bring people out of agriculture into other sectors. But this would then need continued public and PPP investments in irrigation, modern storage and warehousing systems, roads, electrification, agriculture, R&D, and digital connectivity. So these would yield high returns and bolster the rural economy. But at the same time, one has to understand that India is rapidly urbanizing, and urban areas currently account for about 60% of our GDP. And this is not surprising, because whether you look at high technology manufacturing or modern services or exports, all of these predominantly happen in urban areas. And urban areas and agglomeration tends to raise both productivity and wages. And hence, there should be a simultaneous focus to invest in cities as growth hubs by improving the urban infrastructure, including housing and transport infrastructure. There should be greater use of transport-oriented development principles and improve the functioning of land markets, which are very important for urban areas to realize their potential. And this land markets can be improved by improving the master planning and modernizing bylaws. So in conclusion, strengthening rural-urban linkages will depend on strengthening the market access, improving connectivity, providing portability of social protection, and developing secondary cities and towns.